What we're going to be talking about today is buying stocks at ridiculously cheap prices.
I like to think I have a green thumb when it comes to my houseplants and also in the stock market. Moving away from the houseplant, we'll get into a company that has increased its dividend for 21 consecutive years in a row.
It's definitely a great pick and really cheap right now.
There's a lot of really smart people kind of in Silicon Valley that are losing faith in the AI trade. I think if that narrative grows, we're going to, the pendulum will swing back and kind of these boring blue chips will come back into favor.
From a valuation perspective, this is a miracle. Shares are obviously trading at this significant discount. Hello, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with our co-host, Nicholas Ward. It's great to see you today.
Yeah, great to see you, Brad. Looks like a change of scenery, so I'll break the ice. And where are you today?
Yeah, I'm in Miami. I'm at the Fontainebleau Hotel. Actually, one of my friends, he's passed away years ago. But one of my friend's father actually was the provided the capital for this property, which is kind of an iconic hotel here in Miami. But I'm here this week for a couple reasons. I've got a meeting with a friend of mine who's actually a billionaire over in Fort Lauderdale. So I plan on meeting with him later today. And then on Wednesday, I'm actually going to be at Mar-a-Lago. There's another billionaire who lives there. You're probably familiar with. And speaking of billionaires, I'm also today writing our Wide Moat Daily newsletter. So visit widemoatdaily.com for all of our free news. But I'm actually writing about Sam Zell, who I met many years ago, and I wrote about that in my article today. Sam Zell, of course, was a billionaire. He passed away a few years ago, actually just months after I met with him. He's known as the grave dancer, which basically means he would look to buy properties or businesses or companies just when they're starting to fall over into the grave, and he would rescue them. And of course, he would buy them at extremely cheap prices. And Nick, I know that's what we're going to be talking about today, is buying stocks at ridiculously cheap prices.
Yeah, the Sam Zell connection works well. I'm not as much of a grave dancer, cigar butt type investor like he was. I prefer, very stable, high quality companies that have just been, marked with an irrational discount. But that is what we're going to talk about again today. Thank you guys so much. Last week's video is our highest viewed video ever. So, Brad and I said, hey, maybe we're on to something with this 52-week low topic. We'll revisit it. If you guys don't watch this video, we'll move on to something next week. But if you guys like these discount videos, we're here. We're always happy to talk about beaten down blue chips. So I think Brad and I, between the two of us, we have 6 companies that we want to highlight today that are once again trading near 52-week lows. We believe these are great opportunities. These are buys with a significant upside potential. So, Brad, do you want to start, or do you want me to just get going here?
No, we're good to go. But I want to say, speaking of backgrounds, Nick, I know in our comment section last week, there was somebody, called out your plant over there. Now, I just got to ask you, have you put some water in that thing?
Look, I water. I wish I could pan around my house. I've got a palm tree over there. I've got all sorts of cool plants. Look, this is a vine. I'll pull it up. Can we see this? There we go. Look at these in front of the camera. Look at this. This plant is totally healthy. It's just it's a vine plant. So yes, I see the top here. It's not a lot of leaves, but there's a lot hanging down the floor. So anybody wondering about the welfare of my house plants, I take good care of them. I appreciate the concern in the comment section, and I take a lot of pride in my green thumb. So I like to think I have a green thumb when it comes to my house plants and also in the stock market. That's kind of how Brad and I have both made our livings, making good investments in the market. And so now we'll transition to the beaten down blue chips. I do appreciate Brad bringing up that comment. So moving away from the house plant, we'll get into a company that has increased its dividend for 21 consecutive years in a row, meaning, in 3 or 4 years down the road, it will be a dividend aristocrat. I'm certain this company has what it takes to continue to raise that dividend. I'm talking about Accenture, ticker symbol ACN. This is a stock I've mentioned on this channel, several times in the past. 2025 has been a hard year for this company. There's a lot of fear that AI is going to really disrupt their business. So this is kind of like the anti-AI trade. So Nvidia, Broadcom, etc. Those stocks are on the rise. Companies like Accenture, who people believe could be damaged by AI, are falling. But I think it's a great opportunity. Here's the fast graph of this company. As you can see, looking at the black line here, this stock hasn't been this cheap in a decade. It's trading for less than 19 times blended. Is expected to grow 7% next year. So we're at about 18 and a half times forward. That's a great valuation, I think, for a very reliable compounder like this. Looking at the fast graphs here, you see 19 out of the last 20 years positive bottom line growth. What this company does, they're kind of an IT consultant. So they come into small businesses, large businesses, governments, universities, etc., and they just help them to make their processes better, their businesses more profitable. And it's funny because a couple of years ago, kind of when Chat GPT and all these things came out, Accenture rallied big time because there's this narrative: you're either going to adopt AI or you're going to die as a business. And a lot of people were using Accenture to figure out how to adopt AI into their business models. The stock was trading for, here we go, 33 times just a couple of years ago. This was a blue chip compounder that was in favor. Now it's out of favor. People are worried that these large language models, these digital assistants, etc., are going to just kind of replace the human consultants or even large consulting firms. I don't think so. And neither does Wall Street. So Accenture is expected to grow at 8% this year, 7% next year, 9% in 2027, and 8% in 2028. So once Wall Street is not concerned about the growth, high single digit growth, because of the recent sell-off this company's experienced, the dividend yields at 2.7% right now. That's as high as I've ever seen it for this company. Like I said, they've been increasing the dividend for more than 20 consecutive years. I expect that to continue. So all in all, Accenture trading at, a decade, basically like a generational low. Yes, it got cheaper during the Great Recession, but it didn't even get as cheap as it is today during the COVID sell-off. So we're cheaper now than we were during COVID. You've got to go way back to kind of like 2012 to get a cheaper valuation than you see today. I really like this company. It's boring. Most of these are, like I said in last week's video, if you're not exciting, you're likely out of favor in today's market. However, I'd much rather pay, 18 and a half times earnings for a company like this than speculate, at like 50 times earnings for a, growth stock, which also could be disrupted by AI. We're seeing Peter Thiel sold all of his Nvidia. That news broke over the weekend. So there's a lot of really smart people kind of in Silicon Valley that are losing faith in the AI trade. And I think if that narrative grows, we're going to, the pendulum will swing back and kind of these boring blue chips will come back into favor. So Accenture, that's my first pick, 52-week low, 10-year low valuation, 2.7% dividend yield. Nothing bad to say about this company.
Yeah, that's a great pick, actually, Nick. I've heard about the company. I've got friends who worked at that company, and I think it's definitely a great pick and really cheap right now. So let's move on to number two.
Yeah, number two doesn't have the longevity, doesn't have the long history that Accenture has. It's a newer company, Blue Owl Capital. This is an alternative asset manager, probably more up Brad's kind of area of expertise. I think Owl Rock and another company came together to combine credit and real estate, alternative asset management type holdings a few years ago. I'm looking at the chart. Here's the fast graphs. It's been public for, I think, about 4 years now. Every single year that it's been public, Blue Owl has increased its earnings and its dividend. This year it's expected to grow earnings at around 7%. Next year, we're back up to that 19-20% growth rate. So 2025, once again, has been a tough year for alternative asset managers. Ares Capital, Blackstone, all these companies that are larger. This company, what the market cap here? We're looking at a market cap of, about 10 billion. So this is a relatively smaller company than those, but it's much cheaper. And that's why I'm talking about it today. Generally, I do buy like the BXs of the world. I think that's clearly the leader in this space. If you want the biggest, safest, biggest dog in the fight, I think Blackstone's the way to go. But Blue Owl is growing faster, and so is its dividend. And after the sell-off, this company has the highest yield in the space. So, it wasn't long ago, this company was yielding 3.5%. And a lot of people were kind of overlooking it. and thinking of it as a dividend growth stock. Because yes, the dividend's been compounding at 10 to 20% a year since it came public. And management has talked about a long-term plan to continue that growth rate. Now the stock yields 6.2%. This is the highest dividend yield this company's ever had. It's the lowest valuation, as you can see on the fast graph, since it became public. I've got some kind of data here. I know a lot of people probably aren't super familiar with this company. So they have $295 billion of assets under management. So yeah, it's a smaller company, but that's still a very significant holdings. That's divided up between credit, which is 152 billion, real estate about 75 billion, and then kind of what they call strategic capital, basically private investments similar to venture capital at about 70 billion. So it's not the biggest company on the block, but they're growing. Their fees, their revenue continues to grow organically. Their fee-based revenue continues to grow, as do their distributable earnings. Here's another chart just showing that between over the last year. So I like this company a lot. It's something that I know our subscribers, back when Brad and I were on Seeking Alpha at Dividend Kings, there are some people that were like, they love this company. And I could never wrap my head around the valuation, but that was back a couple of years ago when we're trading for 30 times earnings. I didn't see it. It didn't make sense then. Now we're at less than 18 times. We're at like 17 times forward. Now this company has risen up my watch list, and it is something that I may be adding to my portfolio in the near future. I like these asset managers. I like alternative assets. Brad and I talk about diversification all the time on this channel between the different stocks you own, maybe physical real estate, maybe gold if that's what you're into, but private credit and private companies, that's another way to get diversified. And this is the type of company that a retail investor like you or me could do that with. So Blue Owl, a little more speculative than I think most of my holdings are. The company just increased the dividend recently. I think it's fine. I think this is a good company. If you're looking for a higher yield, or somebody last week when I talked about Brown and Brown, they said, hey, 0.8%, I'm not interested. Well, here's a 6% yielder. Hopefully those types of people are interested in Blue Owl.
Yeah, Nick, great pick. Great minds think alike. I was actually thinking about, when I was screening through the 52-week low list, I saw Blue Owl pop up, and I thought about sending you a message that I was thinking about talking about it today, but you beat me to it, and so that's a great pick. I would have picked it as well.
Yeah, no, I know Stephen Hester, another Wide Moat analyst. He would be the expert on this company. He's a kind of our options analyst that works on these high yield plays. So, what next time, whenever we get Stephen on the show, we'll have to remember to get Blue Owl back into the discussion. I'm sure he has even more intelligent things to say about it than I do. So I will move quickly to my third pick. I've got 3 picks and then a bonus like last week. The third one is another company that I've talked about on this show several times in the past that just continues to get cheaper. Talking about Carlisle Company. This is a building supplier. They do roofs. They specialize in the flat roofs, like on the top of your Home Depots or your Walmarts, etc. They do building insulation and they do doors. So nothing overly exciting. However, something that every building needs. Not only does every new construction need these things, but every 10, 20, 30 years, etc., older buildings need these things. They focus on insulation and kind of new age efficiency products. So it makes sense to kind of upgrade to a Carlisle roof, when you're managing a large piece of real estate from from an efficiency standpoint as well. So I like this company. It's getting very cheap. Just about anything related to buildings out of favor. We were just stopped out of Owens Corning in our front end portfolio. I hated to see that company go. It's a wonderful company. It's down, 25% this year or something. I don't think it's a rational decision by the market. However, anything related to building and real estate, we talk about REITs all the time too, are just out of favor. Interest rates are falling, but not as quickly as I think a lot of people hoped. There's a lot of economic uncertainty in the markets right now on a macro point of view, and that impacts the construction market. And then we're seeing some kind of immigration uncertainty as well from a political standpoint. So there's a lot going on that's negatively impacting these building companies. But long term, I like all of them. I like Owens Corning, and I really like Carlisle here. This company in particular has this 2030 vision that they came out with in 2023. At the time, they called for $40 plus in EPS by 2030. They're expected to increase their margins. Here's kind of their, on their website, all the stuff they have to do. mid-single digit organic growth, double-digit EPS growth. They want to buy back shares. They want to get more efficient from a margin standpoint. Well, if the stock's trading at $306 today, if you divide 306 by 40, that is a very low, what do we got here? 7.6 PE ratio. So if this company is correct about those 2030 targets, which is still 5 years down the road, you're buying it at a forward 7 times earnings multiple. This company's long-term average is 18 times. So if they're trading for 18 times 40, this is a $720 stock in 2030 if management's correct, and if the market continues to kind of put that 18 times multiple on shares. That means in the next 5 years, you're looking at more than a double here. The company yields 1.4%. It grows its dividend every year very consistently. So to me, Carlisle is a beaten down kind of blue chip in the building space, very out of favor. But like I said, over the next 4 to 5 years, I think this is a realistic double, and that's fine. That's not a overly exciting CAGR. We're not 20-30% a year from here, but 12 to 15% a year over the long term. I like that a lot. This company's very reliable, and its payout ratio is very low. So even if for whatever reason they struggle to grow their earnings in any given year, they still have what it takes to increase that dividend just from a conservative payout ratio standpoint.
Yeah, great pick, Nick. I agree. I think a lot of these building firms are really beaten down. Also, the furniture industry is beaten down as well. I'm not going to, of course, be talking about Lazy Boy or Ethan Allen or Haverty's Furniture today, but you look at a lot of these furniture stocks are also beaten down for those same reasons. So at any rate, well, Nick, let's go to number 4 and finish up your set.
Yeah, this is my 4th pick. This is a company I've owned before, and then it got expensive and I sold it. And now that it's cheap again, I'm thinking about buying it back. With a caveat, this company has struggled to grow its earnings in recent years. So I'm including this as a bonus pick because you have to believe in the turnaround. I'm talking about Hormel Foods. Once again, very boring, Midwestern company. They focus on pork and turkey, but they have taken steps to diversify away from just kind of like being a protein wholesaler in recent years. They're investing in branded protein to get a higher margin, and they've expanded into largely into peanuts, so peanut butter, and they own the Planters brand, which many people probably know. So not only Hormel, everybody knows Hormel. They're the number 1 pepperoni player in the country. They own Jennie-O, which is the biggest branded turkey play. 40 of their brands, they say, are either number 1 or number 2 in their given categories. So they are focusing on kind of the best in breed plays in that grocery store meat aisle. They own Holy Guacamole, which you may not have known. A lot of people like guacamole. This company recently acquired them, and they own they own Justin's peanut butter, which is kind of like a high scale, like organic type of peanut butter. And then they own Skippy, which is the second largest peanut butter brand in the country, and I think it's got like 20% market share. Kind of a cheaper. So they're investing heavily into peanuts and into meat. And I like that because a lot of these food companies are suffering in this kind of post Ozempic world because people are eating less calories. They're not stacking as much. Everybody's on a diet. Everybody's trying to look nicer. But what we're finding is people that take these GLP-1 drugs, they have to maintain their protein intake or they become very unhealthy. So this is a company that focuses on protein, on natural proteins. It's not really the plant-based stuff. It's not, I wrote a WID. That's what we call our Wide Moat dailies on, on one of the, or on a few of the kind of artificial meats companies that are doing really poorly right now. This is not, this is real protein, comes from animals, comes from plants, etc. I like this company. Looking at the fast graph, you'll see this is as cheap as it's been since the 2008, 2009, kind of debacle. This company for years and years and years traded with like a 2% dividend yield with like a 25 times earnings multiple. They were in the same kind of categories like a Coca-Cola and a Pepsi as far as reliable earnings growth and dividend growth. However, for 3 years in a row, because of inflation, largely of massive input costs from rising meat and rising feed prices, they've posted negative 12% earnings, negative 2%, and then this year expected negative 14%. So Hormel is struggling from an operational standpoint, but they're still very profitable. They still own all those kind of best in breed brands. Wall Street thinks they're going to turn it around next year. 9% earnings growth next year and 9% in 2026 as well. So if that occurs, maybe the sentiment changes. This company's trading for about 15 times forward right now. Its long-term historical average is 20 times. So if we put a 20 times multiple on next year's earnings, we're talking about a $30 stock. Shares are trading for about $22 today. So that's pretty significant upside. And the good news is you get paid while you wait. Hormel yields more than 5% right now, which might shock a lot of dividend growth investors. I know for years this was a 2 to 3% yield max. It kind of hovered in between those. I never would have dreamed that you'd see Hormel with a 5% dividend yield. That's a utility, a REIT, kind of a very slow growth, out of favor company type yield. Well, here we are. We have it. So if you believe in protein, if you like turkey, if you like pork, and if you like peanuts, I think this is a very interesting company to consider. It's one that's rising up my watch list. You've got to believe in the turnaround, but if you do, I think there's like 25 to 50% upside in the next couple of years with this kind of very out of favor consumer staple.
Great. I like that pick. I like all these picks, Nick. Great job. And of course, now I'm going to switch over to my lane, real estate investment trust. I actually wrote my article today for Wide Moat Daily, widemoatdaily.com is where you can find it, sign up for free. But I wrote today about, I think the title to this article is something like, "It's the best time in my lifetime to buy REITs." And I'm serious. And you'll have to read that article because I back it up with some really solid facts. I know it's been 2 to 3 years. I know we've underperformed. Nick, you showed a chart last week in our episode about showing that the real estate category was the worst performing in the JICs. But I think that the tides are getting ready to change, and they are changing right now. Now, I'm going to do a two for today. That's 2 for 1. Many of you have asked for comments in the chat board here at YouTube about Americold and Lineage. And of course, Americold and Lineage are both cold storage REITs. And Nick, kind of tying into your food play at Hormel, these are mission critical freezers. Now, let's start with Americold, and I'll try to balance the content here. Americold has been around for over 120 years. Now, they IPO'd or actually became a REIT in 2018. They are considered a global leader in cold storage with a network of 235 strategically located mission critical warehouses. Now, they have about 5.5 million pallet positions. And that's the thing we want to look at here with cold storage. It's not square footage, it's number of pallets. Now, let's compare that to Lineage, ticker symbol LIN. Of course, Americold is ticker symbol COLD. So Lineage has a portfolio. Well, first, they listed in 2024. So now Americold has competition. In fact, Lineage is larger than Americold. They have 490 warehouses around the country. So they are the largest. Now, I'm going to put up a chart here. You can see the sell-off. This has been a massive sell-off over the last 12 months. We're talking about 52 weeks here. You can see Cold is down 50%. Lineage is down 47%. Let's compare that to the proxy in the REIT space, which is Vanguard Real Estate Investment ETF, ticker symbol VNQ, is down 4.5%. So obviously a lot of pain for investors in Americold or Lineage. However, let's talk about some differentiators. One key differentiator for cold storage, and it's not like the traditional industrial space, the warehouses, again, because I mentioned they're measured by the pallet. One primary reason for this sell-off that we've seen has been due to the ongoing macroeconomic uncertainty we've seen. It continues to pressure as the consumer trends are continuing to weaken. And of course, that's put lower demand on the cold storage space. In the last quarter, it's the third quarter of this year, Americold said it posted a surprise loss on a GAAP basis of 35 cents a share. However, in the REIT space, we like to look at the adjusted funds from operation metrics. In that case, Americold posted 35 cents a share, which was in line. In addition, same store economic occupancy was 75.5% down year over year. So we are seeing occupancies decline slightly in the space. However, management anticipates, and this is a direct quote, total economic occupancy could decrease by approximately 200 to 300 basis points next year. So we're still going to see, I don't know if we finally have hit that trough yet. I think we're getting close. At quarter end, Americold's net debt to pro forma EBITDA was 6.7 times, and the company had about $800 million of total liquidity. It said, quote, it remains disciplined and prudent in capital allocation decisions, focusing on customer driven and strategic partnership projects that are lower risk. Now, in terms of the dividend, Americold also has a $1 billion development pipeline. So there's a little more risk, obviously, with development. You've also always got to factor that in. But the company says it's maintaining that dividend, and we'll talk about why in just a minute, and its investment grade profile. So it is investment grade. It's got a relatively sound dividend policy. Now, from a valuation perspective, this is Americold. Shares are obviously trading at this significant discount. And from a replacement cost perspective, it would be impossible to acquire the land and replicate this 5.5 million pallet positions in this portfolio. Absolutely impossible. So this, again, mission critical. These shares are trading extremely cheap. They have an enterprise value of $8 billion. So there's no way that they can go build this massive portfolio at the price that's being, marketed today with Mr. Market. Now, first, taking a look at Americold, let's take a look. I use fast graphs, and we do that quite a bit every week. Shares are trading at 7.7 times compared with the normal valuation, whatever this means, normal valuation of 25.7 times. The dividend yield is 8.5% with a payout ratio of 66%. That's using AFFO per share. So the dividend is in relatively decent shape. Also, you can see analysts are forecasting growth of negative 5% this year and negative 11% in 2026. So we're not going to see growth ramp back up in 26. And again, obviously, based on consensus numbers, there's still going to be some more pain in the space. Using the 2026 growth estimate and that same dividend I mentioned, which is 92 cents a share, the payout ratio would be 77% next year. So I still think, again, using those analyst consensus numbers, the dividend is in fairly good shape. So I think that dividend yield that I mentioned, 8.5%, seems to be rather safe. There's just not going to be a tremendous amount of growth there. So that was with Americold. I also want to mention, and I think this is important, and I mentioned this in a couple of other videos when we touched on the cold storage space. I think shares are so cheap right now. You could see a company like Blue Owl that Nick you mentioned, Blackstone, Starwood, go down the list, Brookfield jumping in. I do believe there's a very high probability of some M&A in the space. And I think Americold is probably the more likely suitor or candidate for that target, I guess I should say, than Lineage, since Lineage is so new. So I think it'll take about 12 to 18 months for the AFFO per share to fully recover. But for the patient investor, I think you could see some really attractive returns over the next 24 months. Now, regarding Lineage, again, I've got it using this fast graphs. Again, you can see the company doesn't have as much history as we do with Americold. Shares are trading at 10.3 times with a dividend yield of 6.3%. That payout ratio is 65%, still very well covered. Lineage has a better growth estimate, negative 1% this year and negative 2% next year. So if I had to pick one or the other in terms of my deep value kind of grave dancer mindset, I would definitely go with Americold. But listen, it's not going to happen overnight. But I think over the long term, Americold could be a very attractive opportunity. And it could be, in fact, taken out with a private equity firm very soon.
Yeah, I see the market cap's about 3 billion, so it wouldn't be hard, for anybody. 3 billion. Berkshire Hathaway, they got $350 billion right now. It's just pocket change for them. So yeah, I didn't realize Americold had gotten so cheap. I know that a lot of people have asked about this stock. It's not really something I've ever owned before. The dividend growth has been stagnant. That's why they've been paying 88 cents a share annually for about 5 years now. But like you said, the payout ratio is fairly low. So I do think, just looking at the numbers, the dividend looks safe. 8.5% yield. There are certainly worse things to invest in than something that's going to pay you 8.5% while you wait for a big turnaround, or a 25% M&A premium, which I think is a possibility, like you said. So that's interesting. I'm going to have to do more work on that for myself, because it is we talk about cigar butts, you talk about deep value. I think this is a, premier example of a very cheap stock.
Well, Nick, one other thing I want to point out. I mean, when a company gets acquired, say, for example, if Blackstone were to acquire Americold, they're not only getting this massive, portfolio of cold storage properties, they're getting all the people that come along with it. And this is a very different REIT or I guess property sector than traditional sectors, because there is a larger amount of service components. Very similar to like Iron Mountain is another good example. You see all the trucks and shredding in the boxes and all that. That certainly suggests that Iron Mountain has a lot of operations that go in with the company, and so does Americold. But again, for that private equity investor or that buyer, they're getting not only the real estate cheap, but they're getting all of these very skilled, experienced people. I think of this a lot like a few years ago, we were covering, we talked about Alexandria last week in our last episode, but also mentioned Biomed. Biomed was a competitor of Alexandria, and actually the owner of Biomed, Alan Gold, actually used to work for Alexandria and started his own REIT called Biomed. It was just a few years later where Biomed was acquired by Blackstone. And I could see that same setup happening again here. I really believe there's an opportunity for M&A again. That's never serves as a catalyst, certainly, but it's something that I'm certainly aware of. And Nick, I want to just say last thing is, for those of you watching, I'll be at Mar-a-Lago this week. And I want you all to sign up for the Wide Moat Daily, because if you do, or when you do, I'll definitely be keeping you updated of what I'm doing this week at Mar-a-Lago, and I think you'll be really interested to hear about that. So I want to thank you all for watching today. Nick, thanks for being the co-host and taking on the lion's share of this here while I'm sitting in my hotel room.
No, I know you're traveling. I wish I was in Florida. I'm headed to Disney World in a few weeks. My football season ended. Now we're going to Disney as a little vacation. So I'm jealous, but I'll be down in the Florida sun and not too long. So enjoy your trip, and we'll be back next week. Like we always say, please leave a comment, a like, all that stuff. Let us know what you want us to talk about. We're happy to take subscriber feedback into consideration. And every weekend when Brad and I brainstorm these articles, that's what we talk about. So leave us a comment, let us know what you want to hear about, and we will see you guys next week.
Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy swan, sleep well at night investing.